that issues pre-qualifications instead of pre-approvals to their buyers. So there's a lot of times where they're saying, oh, I'm pre-qualified. They think it's a pre-approval because they bill it that way, but it's actually a pre-qualification because no credit has been pulled. They haven't collected the documents for their income. It's just on surface level of what the buyer has put into the application. So that can give a lot of false representation of what's happening. I've had a lot of buyers come to me saying, oh, yeah, I'm pre-approved with X company. And once I hear that, I'm like, okay, we should probably take a deeper dive into this, because once they fill out an application, I'm like, you're really not qualified or pre-approved for that amount. Because their credit may be different, their income may be different, and we'll touch on some of those things in a little bit. But it's really important when you're talking with your buyer to know if they are pre-qualified or pre-approved, just so then you have an idea of what steps you need to take when you're looking at properties. I will take a
screen slide.
Ultimately, while we're doing that, the pre-approval is ultimately a risk mitigation tool that for the lenders and for the buyers. So ultimately, this whole game of mortgages is all about risk. Where's risk assigned? Where's the least amount of risk? How can we get to the end? Evaluating all the risk and making sure that the buyer can still qualify for this. So one of the most important things of the pre-approval process that we look at, and this is usually outside of pre-qualification, is what is a credit score, or is the credit. So we want to dive into what the credit score is and why it's important for the buyer to know what that is and for us as a lender to know. The credit score is ultimately going to set up what program somebody may qualify for, what investor somebody may be able to use. So that's like Fannie Mae, Freddie Mac, WIDA, Ginnie Mae if it's a government loan, or so forth. And also, what if I didn't say yet, what rate they may qualify for, because it's kind of on a sliding scale of where somebody's credit score is to how much risk is associated with that, and that comes back out in the credit score. By a quick show of hands in here, who in here knows what LLPAs are, or loan level pricing adjustments are? Okay, so this is something that we can actually dive into a little bit later in the question section. But Fannie Mae has a guideline. It's a matrix that says how do they charge, or how do they determine what the interest rate they are giving to us as a lender for the money that somebody's borrowing. So it looks at credit score as one of the main pieces, and then it also says, well, what type of property is it? Is it a single family home? Is it an investment property? Is it a condo? Condos have more risk, so it's got more of an LLPA, loan level pricing adjustment on the backside. Does the person have more credit risk where they have a lower credit score? So maybe they're in like a 680 credit score. There's more risk, so there's going to be more of a charge to that. So these are all different things that come into where a credit score is so important for the borrower to know. Now, I want to let you know, this graph here, this is just a graph. These are not actual numbers on what is good and bad. Like I said, I didn't make this slide. Otherwise, we would get some more accurate stuff in here. So to put a little context in, before the LLPA changes that came out in January of 2023, the high credit tier was 740 and higher qualify for the best rates and the best products in that tier. They changed some things, and now the highest credit tier starts at 780. So there's a 40-point gap in there where they put two different categories into the loan level pricing adjustments. So ultimately, we went from 740 plus to now 740 to 559, or excuse me, 740 to 759, and then 760 to 779, and then 780 plus. And I'll be more than happy to show you the loan level pricing adjustments because I think those are very important, at least to give you guys a baseline of what that looks like and how that impacts a rate and the credit score itself.
Is that with nations or all?
All. Yep, that's across the board. Anybody who's getting money from Fannie Mae as the investor or Freddie Mac, they have to follow those loan level pricing adjustments. If a institution is using portfolio money or a broker is using non-conventional funds, then loan level pricing adjustments do not follow through with that. Okay, so that's my little side tangent of something that we can talk with of why it's important for us to dictate the rate with the pre-approval. So debt to income ratio, here is another super duper important piece. The debt to income ratio has two different factors in when we look at an application. There's something called the front end debt to income ratio or DTI and the back end DTI. So the front end looks at just the expenses of the house that they're purchasing and how that impacts them with their qualification purposes or position. The back end looks at all of the debts, monthly debts that they have compared to their gross income for a month. So it's all monthly based. A lot of people think it's based off of the net income, but it's actually the gross income is what we use for qualification purposes, determining the debt to income ratio. So again, the DTI is debt to income ratio, how much debt somebody has compared to how much income they're bringing in. There are different parameters on the different programs of where the debt to income ratio comes in for qualification purposes. On a conventional loan, if we're using Fannie Mae or Freddie Mac, typically it's usually 45% back-end debt to income ratio. Sometimes we can get that up to 50%, depends on how strong their file is, what they have for reserves, what they have for credit score. So nothing is black and white in what we do. It's all gray. So we definitely have to manage in the gray, and everybody's situation and scenario is different. And so that's why we have to move and be agile and try different things to make sure we're putting somebody in the right position and the right program to get them approved. Now, going back to the DTI eligibility pieces, FHA, for example, can actually go up to sometimes 55% debt to income ratio. So somebody might have a little bit more risk involved. They might have a little bit lower of a credit score. Okay, well, we might want to do an FHA loan because now they can qualify if they've got some other debts out there. Let's see here. One thing that we talked about when Irick and I were going through this is when we sign our NMLS, which is the ultimately how we do our license, what our license is. We sign every year to say, yep, we attest to this. And we are attesting as a fiduciary to represent and look out for the best interest of the buyers that we're working for. So we are not in this to put them in a position for us to make money, for someone else to make money. We are doing it for their best interest. And we always have to look out for that as the first thing that we do. And I know that's, in our industry, sometimes things can be very variable, and sometimes ethics and morals can be called into question. I always go back to this piece of why we're doing what we're doing and why I do what I do is because ultimately I'm here to help the individual try to buy a home and create that team atmosphere with the realtors that we work with and the sellers that we're working with to make this as smooth as possible. So it's knowing that, going back to that piece, is really important. So we never want to put somebody in a position based on what their DTI is, their debt to income ratio is, to put them in a house poor situation, to make them be in a situation where we're misrepresenting their income, misrepresenting their debts. That would be considered mortgage fraud, which we do not want to do. Again, we have that fiduciary responsibility to accurately get the information that we need, put it into the application, and come up with a solution that way. All right, we are good. So we're going to dive into a little bit here of the income verification and documentation. Now, here's where things get tricky because, again, every scenario is different. Everybody is working a different job. They're working different hours. Their employers are different. What type of job that they're doing is a little bit different. So that is why we verify income. Because if we do not accurately represent somebody's income in the pre-approval process, we may over pre-approve them for an amount that they don't necessarily qualify for. And the other thing that I will say about the pre-approval process is it is not a guarantee that they are going to get the loan. A pre-approval is that the lender has evaluated the loan process based on credit, assets, and income, which we'll get to assets next, and employment, that they actually meet our criteria that we have set forth to do that loan. Once they have an accepted offer, then we dive into things even more in depth to make sure that everything does check out. And that's essentially the job of what an underwriter is. So some common documents used for the income verification process. So this really depends on what type of job that they have. So ideally, everybody's like golden ticket type of employee. I always like to use the idea is like an epic employee. They are a salaried employee. They make a good job, and it's all straightforward, and we can get all the documents needed. Where we start running into issues are people who work for a union, and they might have a contract with this employer, with this employer, with this employer, and they've been doing this for 5 years. We always have to look back for income the past 2 years. So now we have to collect W-2s from all of these past union employers to verify that, yep, this is how much they made, this is when they were working, and it all checks out. Healthcare staff is another one that can be very fluctuating. So when we're working with nurses, they might work split shifts, differential shifts. So, okay, how is that calculated into their total amount of income? So it's not something that we can just go through and all of a sudden be like, yep, you're pre-approved based on this. We can, depending on certain circumstances, we can give a general idea of saying, based on what you're asking for and where your general income is coming in, yeah, we can pre-approve you. But if we're tight on those margins, we're going to not issue the pre-approval, and we're going to dive into depth on this to make sure that we're getting an accurate representation of where that is coming in. So there's some institutions out there right now in our area who are saying, hey, we'll get you a pre-approval in 15 minutes. Yeah, that's not always a good thing. They can issue something, but are they really doing their due diligence to dig deep to make sure that they are doing everything right for that specific individual that they're working for? If somebody is self-employed, that's a whole nother bucket of worms, because now we have to get tax returns. Now we have to see what type of other businesses that they have out there. Does their business make money? How long have they owned that business? Are they commission-based? How long have they had that job? Do they get bonus? How long have they been receiving bonus? Is the bonus consistent? We always have to look at things usually on a 2-year average for commission and for bonus. A new guideline that came out for self-employed borrowers is if they've owned their business for 5+ years, we only need to show the last year of tax returns to qualify them on. So that's kind of a new thing that's pretty nice. But if they've owned the business for 4 years, we still then need 2 years of history.
So for a real estate agent, would we have to have like an LLC or an S corp situation, or would we qualify it in that category if we don't have the LLC?
If you don't have an LLC, it's not the end of the world. You would just be considered a sole proprietor, and it's still, we would need the 2 years average of your income. And so we all know that when you start a new job like real estate, you might not be busy right away, but it might ramp up. And then all of a sudden you start getting more business towards the end of that 2 years. That sometimes can be a benefit. But ultimately, we still then have to look at the backside of things to be like, okay, we have to go back to make sure that we count all of the months. So there's different calculators that we use to determine all of this that's based on Fannie guidelines, so we can accurately come up with these scenarios. And then if there's multiple borrowers in it, we have to weigh out all of those. A lot of times what we do with the pre-approval process and in the approval process is we try to take the path of least resistance. So how do we get somebody to the finish line with the least amount of work that they have to do? So if we have somebody who's self-employed and they are married, or they are doing this with somebody else who, let's just say, is an Epic employee, and they make a good amount of money, and the person can qualify based on just the employment from the Epic employee, we might not even count the employment of the self-employed person, because then we don't have to collect any of that information. So again, we try to see and navigate the path of how is this going to be best for that couple, that individual, that situation, to get them to the finish line. And ultimately, we want to collect all of that up front so we can issue an accurate pre-approval. So when you are out looking at houses with your buyers, you can feel confident. And I think that's kind of the big piece. Let's see here. Did I have any additional notes? Nope. We can move on to the next one. And the next place where we're going is employment history and stability. So here is a change that has happened. Is the word stability. Stability is something that, or what's the opposite of stability? Volatility. Variable is kind of what we would use in our world. So variable income is something that the investors are really cracking down on. When I say investors, that's Fannie Mae, Freddie Mac, or whoever is providing the funds. So I just had a situation where we had a buyer who, unbeknown to them, they were working for their company. They've been there for 5+ years. Their company got bought out. Her job was salary when she was with Healthcare X. Healthcare Y switched her from salary to hourly. So that's a change. And now, because they switched over, her hours have been not, like, her contract says that she's guaranteed 40 hours a week, but she hasn't been working 40 hours a week based on what her pay stubs are saying. So that all of a sudden creates an inconsistency, and now we're showing that this is now going from stable to variable, and that's an issue. So we have to figure out variable income, which is not consistent matching up, has to have an average over 12 months, or we have to show what the variable income is for 12 months.
At what point in the process are you determining someone's, I just had this happen, so I'm very curious.
Yeah.
At what point does it happen when you determine, okay, this is stable income versus variable? I mean, I'm sure you initially look, but at some point you're kind of taking their contract.
So it depends on everybody's situation. So if we know that somebody is, a lot of times we'll take them for their word at, okay, I'm a full-time employee, but until we collect the pay stubs and put it into our calculator to say, okay, the pay stub saying that you're working X amount of hours per week, and here is what it is. And that's why we don't collect just one pay stub. We collect at least 30 days, or excuse me, a month worth of pay stubs, so it's usually 2. Then that comes out and we can analyze things. Now, sometimes people take vacation. They have an issue that comes up where they just weren't at work. Can the employer, through a verification of employment, help us identify that, yes, they guarantee that they are 40 hours a week. They will get 40 hours a week, but this was something else that they couldn't control that came up. Okay, that's a way that we can overcome that. We're doing our due diligence to show that this person does get the 40 hours a week, and that's what we can qualify them on. If they don't, we have to use a different calculation to get them to where they need to be. So we try to do that upfront with a pre-approval process to make sure that we can do this. Now, do things change throughout the process and we might not catch that right away? Yeah, of course, because people's jobs change, people's employments change, and we can ask all the right questions to the buyer, but it's what is the buyer providing us with information Are they accurately representing themselves? So usually the documentation does not lie. And I think that's why it's super important in somebody who has a non-salary position that's full-time, that we collect that documentation up front. So it may take a little bit longer to issue the pre-approval for the full amount, but we're doing our due diligence to get there. So it makes your job easier on the backside.
Yeah, it came up a week before closing, and I had to bring an additional, almost 50,000 closing.
Yikes. Oh, hate when that happens, but
it was rough. But
yes.
It worked out.
Yes, ultimately that's kind of the big piece in there. So going back to employment history and income, we always want to show 2 years worth of their past income that they have coming in. If that's at the same job, if that's at different jobs. So kind of like what I said with the union employee, if over the course of 2 years they worked at 7 different contracting positions, okay, we need W-2s from all of those places, and we have to do a verification of employment for all of those places to make sure that they were employed during this time to that time. So it takes a lot to do those types of things, where if we have somebody who's at Epic, it's super easy. They have everything on the work number. We go and they pull it, boom, it's done. So that's something that we can literally do usually in 15 minutes or less. How can job changes or gaps in employment impact the pre-approval? So if all of a sudden, and this happened a lot during COVID with the job gaps, because all of a sudden people were furloughed, people were laid off, people lost their jobs. They couldn't find a job because what industry they were in wasn't hiring. Service industry people had this affect them a lot. But ultimately, what we have to determine is, why did they not work during this time? Was it a situation that is suitable to the investor, Fannie Mae, Freddie Mac, to say, yep, we're okay with that? A lot of times the borrower just needs to sign a letter saying, I had a health situation from this month to this month. I graduated college and I did not start my job for 3 months, so that's my gap. That since I went to college, somebody who's in school, that counts as a job. So if they're in college, so as soon as they're coming out, we can use school transcripts to count as verification of employment for schooling. So it's not like they have to have 2 years of history working prior.
Is there any kind of gap that you would write a letter or have a statement about that would be like, ooh?
Yes. That's a loaded question.
Hold on. Ask that question again, because I want everybody.
How did I ask it? Let's see. Is there any type of gap that wouldn't be, like if you were furloughed, that's kind of, I would think, a reasonable, having a child, but jail or other type of things that would not be reasonable.
Okay, so reasonable is in the eye of the underwriter. So every underwriter is going to evaluate that a little bit different, but a lot of it's going to be neglect on the person. So I just didn't want to work. I just took time off and wasn't going to do anything. That's not a reasonable thing to then qualify, because what's to say that you're not going to do that again? And then now if you do that again, you don't have income to pay for your mortgage. So that's how the underwriter, when they're evaluating the guidelines, they have to say, does this go back to, can it be stable employment? Is this person stable to continue their employment throughout the process? So we don't see a lot of those, but they are unique situations where they do come up. If somebody has a health or emergency crisis, which doesn't allow them to work, yeah, that's fine. If somebody got laid off and they searched for a job for 3 months, they got their new job and started, yep, that's perfectly fine. But they just have to identify that says, here, this was my situation and I'm attesting to this. And then they sign that letter at closing.
So for some newer buyers, that would not be a stopgap and a reason not to even move forward with trying to get a mortgage.
Correct. And that's where it's so important that they sit down and they talk with their lender and they go through the pre-approval process, because they're going to be able to uncover these gaps, these situations that could potentially be an issue. So that's a great question. Thank you so much for bringing that up. I think we can probably move on to the next one. which was down payment and assets, excuse me. So when we do the pre-approval process, it's important to know roughly how much money the buyer is looking at putting down for a down payment. Now, there's the misnomer out there between everybody and anybody who parents have bought a house that says, you need to put 20% down. There is nothing, no rule that says you have to put 20% down to buy a house. The different programs that are out there have different minimum requirements to qualify to buy a house. So standard conventional is 5%. If you qualify for Home Possible, Home Ready, that's 3%. FHA, 3.5%. VA, 0%. If you do a WIDA loan, it's 3%, but potentially you could have that paid for through a down payment assistance. So every program is different, and that's where we need to evaluate their total risk portfolio. If they can qualify on the minimum of down payment, anything more that they put down could be a benefit to them. But it's not always required, and it's not always the best thing for somebody to put down more than what they need to. So I know sometimes I was talking with somebody the other day, and they're moving from England back to Madison and want to buy a house. They want to put 10% down. They said initially they want to put 20% down because they want to avoid PMI. Well, I'm like, well, think about it. You're moving back. What else do you have to do at that time? Do you have to buy a new car? Do you have to buy all new furniture, get things set up? Because you don't have anything. You've been living in England for 5 years. You're not going to ship all of that over here. So maybe it makes more sense to put 10% down because there's different mortgage insurance buckets, 3 to 5, 5 to 10, 10 to 15, 15 to 20. Depending on where you put your down payment, the higher you do it, the less mortgage insurance you pay. If you have good credit, you're going to be paying very little mortgage insurance. So don't let people get scared off by mortgage insurance or PMI through the process. That's something that we calculate into the pre-approval process, saying, here's a snapshot of where mortgage insurance would be coming in. We put that into the loan application, so it's already calculated in there. But that is why the down payment is super duper important for us to know and to evaluate. So also, where are those funds coming from? Do they have it in their bank account? Do they have it in an investment account? Is it liquid? Is it tied up? Is it retirement? Is it gift funds? All qualified things, but how are they going to access that? Is there a penalty to access that? And how quick can they access the funds? So sometimes they might have an investment account where they have plenty to do a 20% down payment, but the cost or the fee to withdraw money out of an investment to liquidate it might be more than what it is to do a 10% down payment, which they have in their bank account. So that's where we try to, again, use our fiduciary responsibility, look out for what their best interest is. The other piece that I want people to know is this is not set in stone during the pre-approval process. Just because we say, okay, they're putting 5% down, 10% down, 15% down, doesn't mean that that's what they have to end up with. We are there to help navigate that. If we qualify somebody and say, okay, you only qualify if you put 10% down, then you have to put at least 10% down, because maybe your debt to income ratio is higher than the qualification piece of 45%, 55%, somewhere in there. And then now we don't get an approved eligible from the investor. We can't go below that unless there's something that changes. We reduce the loan amount. We reduce the purchase price amount, something of that. So again, this is very fluid in the process. And that's where it's so important, once we issue a pre-approval, that we have communication with the agents that we're working with. Once we issue a pre-approval, it's not just saying, all right, go have fun, shop all you want. It's saying, if you find something that you're interested in, you want to write an offer on, come back to us. Let's reevaluate, make sure everything checks out. You know what the numbers are and where things are coming back, so you can actively feel confident in the offer that you're submitting, that if it gets approved, you want to move forward with it. Because nobody wants to write an offer and then all of a sudden somebody sees the numbers and they're like, yeah, that's too high for me. We don't like that sticker shock. So again, I told you the typical down payment percentages on the low end of what's required. Ultimately, they can put as much down as they want on top of that. It's ultimately up to them. 20% is the one piece where it's like, okay, that's where MI falls off. If it's an FHA loan, remember that they have MIP on it for the full period. So the mortgage insurance for FHA loans does not go away unless they refinance.
So how much would you estimate is mortgage insurance? Clients ask all the time. Really, how do they talk to the lender?
Okay, yes, that's the correct answer, is talk to the lender, because everybody's situation is different. So it depends on what their down payment is, what their credit score is, what their DTI is, going back to the debt to income ratio. All of these factor into a calculation. Then for us, I'll use Nations Lending for an example. When I run a mortgage insurance quote, I work with 5 or 6 different mortgage insurance companies that all give me quotes. So then I can choose what is going to be the best one for them in that scenario. Some companies are willing to take on more risk and have a lower cost. Some companies are like, nope, that's way too much. We're not even going to give you a quote for that. And sometimes people are like, oh, this is easy breezy. Boom, we'll do this, and we want this loan, so we're going to do it as a super low amount. Normal factor is 0.2%, or 0.2 factor is what I always like to call it, on the amount. So when I'm running scenarios, I use that as kind of the threshold of, here's where we're at. If it's higher than that, how much higher than, how much more higher than 0.2 is it, or is it below 0.2? So sometimes if you get somebody who's putting 15 to 20% down, it might be at that 0.2, 0.15. I've seen it as low as 0.1.
And is that a percentage against the property's purchase price?
Yeah.
So like 0.15 times 400,000.
Yeah, I would have to run the calculation. I think it's based off the monthly payment.
Okay.
Yes.
So is it, mortgage insurance is based on the mortgage amount though? Or is it about the same regardless if
It's gonna
$100,000 loan or a $200,000 loan?
it's gonna be based on the loan amount.
Okay, that was one question. The other one
Yep.
was, and this might be too expansive, but so private mortgage insurance purchased by the bank, let's say, or
The lender.
the lender.
Yep.
Yes. Okay, is only up to 20%. Why at 20% can that be dropped? I mean, what if somebody has defaults on their loan when they have 50% left to pay on it?
Yep. So it all goes back to the risk tolerance. How much risk do the investors want to take? And this is above my pay scale, but they came down and they came with the conclusion that says at 20% is where we feel confident that if somebody is putting 20% or more, or if they get to the equity of their home is 20% or more, that if something were to happen, all of the funds can be recouped of the mortgage. So if there's a foreclosure or something that happens, there's enough equity in the home where they can then pay off the mortgage, what they have, and any other costs associated with it. Anything higher than that is where that insurance, the mortgage insurance, comes in to help cover any of that gap of where it may be if it goes down that road. But I don't know why they chose 20%, but.
And so same thing when someone purchases a home and they're paying PMI, they have to, what's the process for dropping the PMI? I know it's.
Ooh, good question. So actually, there's a couple different things that can come up when dropping the PMI. So automatically, if a buyer does nothing, once the loan hits 78% loan to value, PMI will automatically drop off. 78%. Once they hit 80% loan to value, so it's like they would put 20% down, the buyer can then request for mortgage insurance to be removed. This can be for a couple different reasons, because they've paid down the mortgage to get to that amount. the home has appreciated and now has a higher value, which then causes the loan to value to be less. That's in our industry or in our area, that's usually the one that happens the fastest because of where our appreciation values on homes have happened. But usually when somebody does that, what is required is that they will most likely have to pay for an appraisal with their servicer to go out, evaluate the home to say, yep, this is correct. This is where the value is. Let's run the calculations. If it's below 80% loan to value, MI is removed.
So I just want to make sure I'm understanding that. So if you get to 78%, it automatically drops off.
Yes,
You don't have to take any action.
correct.
But if you have now a loan, an LTR of 20% because your house is appreciated and you didn't actually put that down, but it's appreciated, but it's at that 20, you would have to request it.
Yes.
Right? No one's going to do it for you. You have to know where you're at.
Correct.
Okay.
And that's why we always say it's important. And that's why we don't disappear in the process with the people that we do loans with, is we constantly are in communication. We know their scenarios and we do mortgage reviews with them. So it's usually on an annual or a biannual basis where we sit down and we say, let's talk about your mortgage. What has changed? Have you made any larger purchases or not purchases, payments? So sometimes maybe somebody gets an inheritance and they're like, oh my gosh, I want to put this all towards my mortgage payment. Well, did that change things? Did that move the needle of where they're at? That's a common thing. Sometimes people will buy their house while they're still trying to sell their other house. So they put a minimum amount down. Okay, well now they have all of this income that they're getting from their home sale, and they want to do a one-time lump sum payment on their new home, which will then take them from like a 5% down or 95% loan to value to maybe like 75% loan to value. So that they can do a recast with that to make sure that everything gets changed, mortgage insurance gets removed.
I have one other.
Yeah, you got it.
So it's my understanding that you can do the appraisal, but you have to wait 2 years from the time you purchase your home.
No.
To do that.
No,
That's not true.
that is not true. You do not have to wait 2 years.
I apologize, that one's a good one. Can you say that?
So on the appraisal to get the PMI down, I asked if you had to wait 2 years because it was my understanding that with that loan, you have to wait 2 years.
Yes. No, you do not have to wait 2 years to have the loan recast or refinanced or anything of that. Ultimately, you can do it after 6 months.
Well, not necessarily refinance because you wouldn't be refinancing, right?
You could.
But if just to get the PMI down, you don't necessarily have to.
Right. So it depends on why you're requesting. So remember the two different options. If you made a large payment to pay it down or the appreciation value.
The appreciation.
Yeah, so there's two different calculations that we have to look at and there's two different time frames, but I do not believe it is 2 years. You do not have to wait that long. I don't know that number off the top of my head. I could do some research here after. But it's a great question.
It's that one gets tied into with the question we get all the time too on like, how long do I have to stay in my house for cap gains and whatever? And so these time frames start to overlap, and I think everybody kind of gets some of them stuck in their
Sure.
head. Mhm.
Yep. But no, that's really important to know. And you know what? I am human. So like I said, I don't know that.
I'm wondering if that's across the board or if that's their policy or so.
Yeah. Good question though.
Thanks.
Yep.
And we talked about minimum down payments. What is the minimum down payment for an investment property? Is that like a loaded question?
It is.
Okay, so we don't have to- we can say-
So here, let's give some parameters around that. So it depends on, is it a single family home? Is it a 2-unit or a 3 to 4 unit? Okay. Are you going to owner occupy it? Which it wouldn't be an investment property if you're going to do that. And then it's what type of loan product are you going to use? Are you going to use conventional financing? Are you going to use FHA financing? Or are you going to do something like a DCR or DSCR loan, which you can use for an investment property, which is outside of Fannie Mae, Freddie Mac guidelines. So it's a non-QM loan. Then it doesn't factor or doesn't follow any of those. Yes.
What does non-QM mean?
A non-QM, that's non-qualified mortgage. So that means it's outside of the bounds of what Fannie Mae and Freddie Mac set for their guidelines. So that means it's not their money that's being used, and it is money that is used by somebody's portfolio, somebody's hedge fund backing, something else where they're making up the terms and conditions of what the loan is. So a DSCR, that's essentially, put it in easier terms. Our company calls it RIO, which is rental income only. So that means all the investment property has to do is qualify on the rental income that property is making, as long as it covers the mortgage payment and you meet the criteria with it, you can do an investment property that way. It's DSCR.
What does that stand for?
Yes, thank you, Angie. Debt service coverage ratio. Yes. I was like, I never remember that one, and that's like RIO is so much easier. It's rental income only. So when we do those loans, there's a few different parameters that go along with it, where we don't actually need to look at somebody's income, but that's kind of a one-off, and we can definitely talk about that one after.
I don't want to get off on too long of a tangent, but wasn't that what changed just like a week and a half ago, was the thresholds for down payment for multi-units through FHA?
Yes. So
that was pretty huge news, wasn't it?
That is, and I did write that down. Yes. So 5% down, owner occupied multi-unit. It's 5% is the minimum that can be used for that. Now, if you're a first-time home buyer, which means you have not owned a home before in the last 3 years, you cannot use the rental income of the other units as qualified income in your calculations. So you have to qualify it based on just the income that you have to buy the property. So I see a confused face here. Yes.
Because you have like a mortgage history.
Yes.
So
Yeah, if you're not a first-time home buyer, then
So here, let's throw another wrench into that. If you have landlord experience, so you've had other investment properties, now that's another threshold that you get yourself into. So then you can count all of the income. If you are a homeowner who has a mortgage, and you are buying a multi-unit, owner occupied, you can use 75% of that income on the other 2 units, whatever it may be. Great questions. All right, let's skip to the next slide.
Yeah.
Okay, so the benefits of the pre-approval process.
Sorry, that's my slide fault because I had it. It's on me.
That's,
Slide is perfect.
yeah, I just say I still didn't, I didn't make this, so it's not my fault. But I think, let me ask this to you. Based on the information that you learned today, what do you see as a benefit of going through the full pre-approval process and making sure that you have a pre-approval? Yes. You need to.
Everybody's time if you don't.
Yes.
I mean, I'm a little jaded because now I've been through situations where clients have gone through the pre-approval process and it literally means nothing until you get into the re-verification period of employment. And I think it's more complicated with like the variable employees.
Yeah.
Versus the W-2 employees.
Yep.
So
Yep.
I'm gonna start asking, are you very? I will start asking.
How are you actually making your money?
Yes. So the one thing is where they might not know, because a consumer usually doesn't know what's the difference between variable and stable. So there's like, oh yeah, I'm full time. Well, if I'm full time, but I'm only working 36 hours a week, but my employment says I make 40 or work 40 hours a week. Okay, well, that's a little bit different. So we gotta figure that piece out.
Well, obviously we're in business, to your point, the benefits of with working with agents to get pre-approved. But I know too, at least one of the ones I wanted to share today was like all the potential buyers out there, especially the ones that are like, I don't want to get pre-approved because I know my credit sucks. Or I know I wouldn't be able to buy anything. I can't afford anything anyway.
Yep.
And I would argue, if I could go back and tell a lot of people, they should have gone and gotten a pre-approval anyway, because they know where they needed to go work on in order to go buy a house, because it might not be in the same areas they think. It might not be more necessarily just more income or whatever.
Right.
And there is just so many other things that go into it. So it's not just a benefit for us to obviously push them to do it, but they should be doing it themselves, even if they're not going to buy it.
Yes.
So,
So if we want to go to the next slide, I think that kind of goes into what you were just saying, Dan. Not only during the pre-approval process is it to get pre-approved, it's also to educate. So especially for a first-time home buyer, let's educate them on what it takes to go through and buy a house. You know, there's a lot of times when I'm talking with a new buyer, we have 3-4 conversations before we even get to submitting the application for them to like go in depth and go through things, because they have a lot of questions. They don't know. And especially with first-time home buyers, they don't know what they don't know. I mean, I know that sounds really cliche, but it literally is what it is. So there's a lot of common things that can pop up in the process that we can help overcome and get them in a position where they may semi-qualify now, but if they correct a couple things on their credit report, if they save a little bit more money, well, now we can strengthen that pre-approval. So why would it not make sense for us to have that conversation ahead of time, have them be in a position, so then now 3 months down the road, 6 months down the road, when they want to buy a house, they put their ducks in a row and now can actually feel confident that when they do the pre-approval process again, or they enhance this stuff, they are able to succeed and be ready to purchase a home with their agent. Now, question to the audience: how long does a pre-approval process, or how long does a pre-approval? Let me rephrase that one more time. How long is a pre-approval good for? 120 days.
3 months, 120 days.
Yes. So it's 120 days from the day that credit is pulled, the hard credit pull, because that's when credit expires. Ultimately, the pre-approval just still sits out there. Even if it expires, we still have all of their information. To reactivate it, all we need to do is just do a new credit pull and sometimes collect new documents to verify that their income hasn't changed, that their assets haven't changed, make sure they still have the money that they say they do.
So can I always say, I don't want to get a pre-approval because it's gonna ding my credit.
Yes.
Does it ding your credit to re-pull?
If they have really solid credit, it's not going to affect them that much.
Okay.
It might be like 3-4 points.
Okay.
So if
The
you go,
question was, does it really affect the credit to have it repulled again? I think that's one a lot of people ask. So.
It's a situational basis. You know, if you've got somebody who's sitting at 680 or 660, okay, well, maybe we're not going to pull that right away. And we're going to wait until you see something that you really want. And then we're going to pull, so we can extend that next 120 days out as long as possible, give them the ability to improve their situation. But we are up on time.
Well, and we got started a few minutes late, so if there's, I know on your slide side of things, if we want to jam through a couple of them. Conclusions and key takeaways.
Actually, can we go back to the last one? Because I think
There you go.
here are some major things that you want to make sure that if you're working with a buyer and you are having conversations with them on a consistent basis, if any of these things change, talk to their lender or have them get in contact with the lender right away. Changing jobs during the pre-approval process, bad idea. I had somebody who quit their job a week before closing. And I was like, okay, if you don't have a job, you don't have a house. And this was a union employee. So have you guys heard the wonderful story of the person who was buying their house? They got to the closing table. All of a sudden, they're driving up to the closing with their brand new truck and their brand new boat that they're pulling behind. And they say, hey, everybody, look at what I just bought. And the lender's like, you're not closing on your home today. I'm sorry. We need to reevaluate, because if you financed that, now you may not qualify for your home. So would you rather live in your truck and the boat, or would you rather have the home? So as soon as the loan closes, people can go out and buy whatever they want. But during the process, until it's closing, they need to talk with their lender before they buy anything or take out any new credit. I'm just as easy as I can say.
And be thinking of your last minute questions here. I think there's 3 or 4 people, 2 people in the Zoom and 3 or 4 people that are watching online. If you have any last minute questions, type them now.
Yes. The other thing is when you have somebody out who's shopping, who's already pre-approved, say they were pre-approved for a single family home, all of a sudden now they're like, oh, I'm thinking I want to maybe look at condos. Talk to your lender right away because that's going to change completely the pre-approval and what they may be pre-approved for. So that's changing any type of subject property. If that's changing single family home, condo, investment, they need to be in contact with their lenders. A lot of times what we do on our side is we try to have weekly conversations with them so we can uncover these things. But sometimes if they have a search that pops up and all of a sudden they want to go see this and they really like it, okay, boom, that could be an issue. The last one I have is not communicating with their lender before they're writing an offer. This is something that you want to avoid. If you're writing an offer, talk to your lender before you submit the offer. Because one, we want to see, did things change? What's the down payment amount? Because you may have one idea of what the down payment amount, but the pre-approval is saying something totally different. And you're saying, okay, remember that situation I said where they have to put 10% down, otherwise if they put anything lower, they don't qualify? Well, if you write the offer for something lower than that, okay, well now they're not actually pre-approved. So that it kind of breaches against what we go through. But then also what we do is we do address-specific pre-approvals where we'll actually run the numbers based on the calculations of the property that you're looking at with taxes X, Y, and Z. Question?
How do you get somebody, that had this happen where I was against somebody who already had a commitment letter in place before they wrote their offer for their buyer. Of course, they got the accept offer then. How do they qualify for that? What kind of process is that?
So
somebody completely.
So you're talking like a fully underwritten pre-approval process? Yep. So we have that process as well. And that's where everything goes through the underwriting process. With the information, so credit, assets, income, all gets evaluated. The only thing that's unknown is the subject property. So if they can qualify based on that information, we can issue an underwritten pre-approval. We didn't talk about that today because we didn't want to go into depth. We wanted to do.
How long do those last?
Those last for 90 days.
Underwritten pre-approvals last for 90 days.
Because ultimately, after 90
Because they
days.
have expenses going in then before they even wrote the offer. The buyer does.
Yeah. Yes.
Subject to an appraisal, yeah.
Yep. So the other piece that goes with it, why it's 90 days, is because that's when the income and asset documents expire, not credit. So then they have to obtain new documents to say, yep, we still have this account or this amount or this income. I will hang around if anybody has any more questions.
Awesome.
Because this is great and I love this. So thank you so much for having me talk about this today. Really appreciate it.
We had some thank yous online too for got to watch on the go. Thanks for coming, and then we'll get started on our next one here in a minute. Thanks, guys.
That's such a good refresher. Certain things like